Hi everyone and welcome back to Money Experiment PH. We receive a lot of comments asking us which is a better stock between two different stocks or funds and other financial instruments, so we thought that it would be good to make a video about portfolio management and approach. So what is portfolio management? According to Investopedia, a portfolio management is the art and science of selecting and overseeing a group of investments that meet the long-term financial objectives and risk tolerance of a client, a company, or an institution. Portfolio management requires the ability to weigh strengths and weaknesses, opportunities and threats across the full spectrum of investments. The choices involve trade offs from debt versus equity to domestic versus international and growth versus safety. So these terms seem technical and difficult, right? But please stay with us and we will try to explain portfolio management with figures to make it easier to understand. So going with this definition, portfolio management is reducing risk level while keeping expected return. If you're looking for a very high return, you can put all your money, for example, in cryptocurrency, hoping for a high price increase, but this is very risky. So the components of portfolio management are first, diversification. Portfolio management may offer equivalent returns with lower volatility of returns when everything is combined versus when individual securities are on their own. We will make a separate video about this in the future, but for today's video, we will be focusing on the second component of portfolio management, which is asset class selection. Being in the right asset class is more important than being on the right securities, which I will be discussing in the table. So in table 1, as you can see in this column, we have the asset classes, cash, real estate, and equities. Under the second column, it's index or benchmark. We've identified an index for each of the markets which we are trying to beat. So this is only an example. For this example, we are also introducing investors A and B, and the figures under each investor are their portfolio performance compared to the index. So when a cell is green, it means the investor has beaten or outperformed the index. Red would mean underperformed. Orange means it is at par with the index. Here you will see that investor A beat most indices for most asset classes, while investor B is underperforming since most of his portfolio performance are below the index. Comparing investor A and B only from this table shows that investor A's portfolio performance is actually winning. Let's now see the weightings per asset class that both investors have placed in table 2 asset allocation percentage. Weightings mean how much money they have invested in each asset class. So both investors have placed 5% in cash, and basically their difference is that their asset allocation between real estate and equities are interchanged. So as you can see, investor A placed 70% on real estate while investor B placed 25%. And for equities, investor A placed 25% while investor B placed 70%. For this case, we are going to ignore leverage. If you want to know more about leverage, please check out the link below in the description box. Let's now look at the returns of both investors' investment of 100,000 Philippine peso in table 3. So for investor A, he allocated 5% on cash and earned 0.250%, so he got 12 pesos and 50 cents. He allocated 70% on real estate and earned 12% and got 8,400 pesos, and 25% on equities and earned 35% and got 8,750 pesos. The total is 17,162 pesos and 50 cents, or 17.16% for investor A. Please take note that investor A has beaten the index for most asset classes in table 1. Let's now see how investor B did. So he allocated 5% on cash and earned 0.250%, so he also got 12 pesos and 50 cents. Again, the difference between investor A and B is their allocation for equities and real estate. So as you can see, investor B placed 25% on real estate and earned 8% and got 2,000 pesos. He placed 70% on equities and earned 25% and got 17,500 pesos. That's a total of 19,512 pesos and 50 cents, or 19.51% for investor B, who has underperformed based on the index for most asset classes in table 1. If we compare investor A and B, now based on the return in table 3, who do you think performed better? That's right, based on table 3, it is now investor B. While it is true that investor A outperformed the benchmark in the first table, investor A missed out on selecting the right asset class to be in or putting weight on the right asset class in table 2 asset allocation percentage. As I mentioned in the earlier parts of the video, in portfolio management, being in the right asset class is more important than outperforming any benchmarks. Let's now introduce a new investor who we will be calling Investor C, who passively manages his asset allocation between real estate and equities, meaning Investor C divides his asset allocation equally, so that makes it 47.5% each for equities and real estate and still 5% for cash. Let's find out what happens if we compare investors A and B to investor C. Will investor C be able to beat investor A or B? Or will investor A be able to redeem himself? So as you can see in table 3, the percentage of return of investor A is still lower than investor C, who passively managed his asset allocation between equities and real estate. Investor B still made the highest return among the three, and even if investor B underperformed based on the market index in table 1, this just shows how important asset weighting and allocation is. So to wrap up the video, if you compare your portfolio versus the market index only, you may appear to be outperforming, but if you compare your portfolio as a whole, it's not the case. For example, let's say a person is known to be a stock god who only invests in the stock market. He returned 200% while stock market performed 20%. This means he returned 10 times better than the stock market. Now, let's say there is also a person known as a crypto amateur trader who only invests in the cryptocurrency market, and he returned 500% when general crypto market returned 1000%. Crypto amateur trader underperforms so much compared to the crypto market, but still returns so much better than stock god in the first example. Of course, this is just a sample case, and we are not encouraging you to go all in with cryptocurrency. We hope this video provides a deeper insight on portfolios and also answers the question like if stock 1 is better than stock 2, fund 1 is better than fund 2, and etc. Since in portfolio management, those stocks that are being compared fall under one asset class. Comparing two stocks with point to point might not be so meaningful. As long as the companies you are investing in are in good standing and your portfolio is well diversified, you are on the right track. Thank you for watching this video. If you like this video, please hit the like and subscribe button, and don't forget to hit the notification bell to get updates on our videos. You can also check us out on moneyexperimentph.com. Bye!